Are you new to investing and wondering where to start? Look no further, because in this video we'll be providing a beginner's guide to the stock market. Our goal is to provide valuable information that will help you make informed investment decisions and potentially increase your wealth. First things first, what is the stock market? Simply put, it's a place where people buy and sell shares of publicly traded companies. When you buy a share of stock, you become a shareholder and have the opportunity to earn a share of the company's profits through dividends and capital appreciation. The value of a stock is determined by supply and demand, and it can fluctuate based on a variety of factors such as the company's performance, economic conditions, and investor sentiment. Now that you have a basic understanding of the stock market, let's talk about how to get started. One of the first steps is to choose a brokerage firm, which is a company that allows you to buy and sell stocks and other securities. There are many different brokerage firms to choose from, and it's important to do your research and compare the fees, account minimums, and other features before deciding on one. Some brokerage firms offer commission-free trades, while others charge a fee per trade. It's also a good idea to consider the types of investments that are available through the brokerage firm and whether they align with your investment goals. Once you've chosen a brokerage firm, the next step is to open a brokerage account. This is an account that allows you to buy and sell securities, and it can be either a taxable account or a tax-advantaged account. Taxable accounts are traditional brokerage accounts that are subject to capital gains taxes, while tax-advantaged accounts offer tax benefits for retirement savings. Some examples of tax-advantaged accounts include 401(k), IRAs, and Roth IRAs. It's important to consider your financial situation and goals when deciding which type of brokerage account to open. Once you have a brokerage account, it's time to start researching potential investments. One way to research and evaluate potential stocks is through fundamental analysis. This involves looking at a company's financial health and performance, including factors such as its revenue, profits, debt, and management team. You can find this information in a company's annual report, which is typically available on the company's website or through the Securities and Exchange Commission, SEC. Another tool for stock analysis is technical analysis, which involves studying historical price and volume data to identify patterns and trends that may indicate buying or selling opportunities. Technical analysts use charts and other statistical tools to identify these patterns and make predictions about future price movements. It's important to keep in mind that both fundamental and technical analysis have their limitations, and no investment strategy is guaranteed to be successful. It's also important to diversify your portfolio and not put all your eggs in one basket. This means not putting all your money in one stock or one sector, but instead spreading it out across a range of investments. There are many different ways to diversify your portfolio, including investing in different industries, sectors, and asset classes. For example, you might consider including stocks, bonds, real estate, and commodities in your portfolio. Diversification can help manage risk and potentially increase your chances of earning a positive return. One way to diversify your portfolio is through asset allocation, which involves dividing your investments among different asset classes based on your investment goals and risk tolerance. For example, if you're a conservative investor, you might allocate a larger portion of your portfolio to less risky investments such as bonds and cash. On the other hand, if you're willing to take on more risk in pursuit of higher returns, you might allocate a larger portion of your portfolio to stocks. It's important to periodically review your asset allocation and make adjustments, as needed to ensure that it aligns with your investment goals and risk tolerance. This may involve rebalancing your portfolio, which involves selling off some of your investments and using the proceeds to purchase others in order to maintain your desired asset allocation. Another way to diversify your portfolio is through international investing. This involves investing in stocks, bonds, or other securities outside of your home country. International investing can provide exposure to a wider range of industries and economies, and it can potentially offer the opportunity for higher returns. However, it also carries additional risks, such as currency risk and political risk. One way to invest in international markets is through global mutual funds or ETFs, which offer a convenient and cost-effective way to diversify your portfolio across different countries and regions. It's important to research the specific countries and industries you're interested in and to consider the potential risks and rewards of investing in those markets. In addition to stocks and bonds, there are many other types of investments to consider, including real estate, commodities, and alternative investments. Real estate investing can involve owning physical property or investing in real estate-related securities such as REITs, real estate investment trusts. Commodities are raw materials such as oil, gold, and agricultural products that are traded on financial markets. Alternative investments are less traditional investments such as hedge funds, private equity, and derivatives, and they can carry higher risks and fees compared to more mainstream investments. In addition to the traditional stock market, there are also alternative investment opportunities that can be worth considering. One example is crowdfunding, which involves investing in small businesses or startups through online platforms. Crowdfunding can offer the opportunity to invest in companies that may not be publicly traded, and it can potentially provide the opportunity for higher returns. However, it also carries higher risks, as these companies are typically in the early stages of development and may not have a track record of success. Another alternative investment opportunity is cryptocurrency, which is a digital asset that uses cryptography for secure financial transactions. Cryptocurrencies such as Bitcoin and Ethereum have gained popularity in recent years, and they can be bought and sold through online exchanges. Cryptocurrencies are highly volatile and can fluctuate significantly in value, so it's important to do your research and understand the risks before investing. It's also worth considering real estate investing, which can involve owning physical property or investing in real estate-related securities such as REITs, real estate investment trusts. Real estate investing can offer the opportunity for steady income through rent and potential appreciation in property value. However, it also carries risks such as property maintenance costs and the potential for declining property values. Another important aspect of investing is risk management. Risk is an inherent part of investing, as there is always the potential for loss. However, there are steps you can take to manage risk and protect your investments. One way to manage risk is through diversification, which involves investing in a variety of different assets and industries in order to spread out your risk. This can help mitigate the impact of any potential losses in any one particular investment. Another way to manage risk is through asset allocation, which involves dividing your investments among different asset classes based on your investment goals and risk tolerance. For example, if you're a conservative investor, you might allocate a larger portion of your portfolio to less risky investments such as bonds and cash. On the other hand, if you're willing to take on more risk in pursuit of higher returns, you might allocate a larger portion of your portfolio to stocks. It's important to periodically review your asset allocation and make adjustments as needed to ensure that it aligns with your investment goals and risk tolerance. This may involve rebalancing your portfolio, which involves selling off some of your investments and using the proceeds to purchase others in order to maintain your desired asset allocation. Another way to manage risk is through stop-loss orders, which allow you to set a certain price at which your stock will be sold in order to limit potential losses. This can be a useful tool for managing risk, but it's important to keep in mind that stop-loss orders are not guaranteed and there is still the potential for loss. In addition to diversification and asset allocation, it's important to stay informed about the markets and the companies you're invested in. This can help you make informed investment decisions and potentially identify potential risks or opportunities. It's important to do your research and carefully consider the potential risks and rewards of any investment before making a decision. It's also a good idea to seek the advice of a financial professional or a trusted advisor before making any major investment decisions. In conclusion, risk management is an important aspect of investing, and there are various strategies you can use to help mitigate risk and protect your investments. It's important to understand your investment goals and risk tolerance, diversify your portfolio, and stay informed about the markets in order to potentially maximize your chances of success. Remember, investing carries risks and it's important to do your research and make informed decisions. We wish you the best of luck on your investing journey. If you have any questions or would like more information, be sure to leave a comment down below. Thank you for watching. Don't forget to like and subscribe. We hope that this video has provided valuable information and has given you a better understanding of the stock market and how to get started with investing.